Okay, hello everyone. Welcome to the Hardy Group Continuing Resources webinar for today, COVID-19 in today's transaction market. This is actually our 11th webinar, which is hard to believe, but we've been doing this on a bi-weekly basis with the goal of trying to figure out how to deal with the crisis we're in and sharing our knowledge that we have with other people that are interested. And we have some outstanding panelists today that are willing to do the same. So I think that by the end of this webinar, we'll have a better idea of where the transaction market is and what it means for all of us in our role in the industry. If you have any questions, please use the chat feature, and if we have time, we'll get all those answered. But it's a great topic for right now because transactions are a big part of our market. And if you can, according to Daniel's latest Selects Hotel Survey for sales, the 2020 through 2019 trade metrics, trades are off in quantity by 80%, by dollar volume 90%, by sales price per room by 40%. So obviously there's been a huge drop in the market. So we're going to talk about all that today. But let me introduce our panelists today, which are all very talented, very experienced, very well known. Bob Webster, I've known for 30 years, good friend. We've done a lot of interesting things together, but he currently is president of the Hotel Institutional Group at CBRE, based in Atlanta, and that institutional group leads the full service investment sales. Bob has sold more than 165 hotels in his 40-year career. He was named by Real Estate Forum magazine Superstar Investment Sales Broker. He also received the Jack A. Schaefer Financial Advisor of the Year Award. And Jack Schaefer was very helpful to me when I first got involved in ULI. So anybody that wins an award based on Jack Schaefer's doing very well. Before CBRE, he was a managing director of Hodges Ward Elliott. He was a director of real estate at Ritz-Carlton. He was early in his career at L&H, and he was an operations manager at the Plaza Hotel. So that had to be pretty interesting. Rob Klein, another good friend. We've known each other for 25 years, CEO of, founder of the Charters Lodging Group. And that's a private equity group based in California. He's in Marin County right now. Bob is in Rhode Island. He is also co-founder of Sightline Hospitality, which is a property management firm specializing in turnarounds. He's been an early stage investor in conference centers, urban hotels, and resort hotels. So his perspective will be very pertinent today. And he was one of the first people to really promote the discipline of asset management and was a founding member of HAMA that I think most people know. Daniel Lesser's 30 years in all facets of advisory and transactional services. He's a leading authority on hotel feasibility and valuations, which is going to be very pertinent for the bid-ask spread. He's lectured at all the major universities that we know, Cornell, Columbia, NYU. He's widely published and quoted, and as a quarterly columnist at Hotel News Now. He was in a senior position at CBRE a while ago and founded the hospitality and gaming group at Cushman & Wakefield and one of the founding team at HVS. So Daniel's going to throw a few slides up, Rob will throw a few up, and so will Bob, and then we'll go from there in our conversation. So take it away, Daniel.
Thank you so much, John. Really appreciate the invite to participate on this panel as I'm trying to figure out, there we go. Can you see the screen?
Yes.
Okay, terrific. Well, greetings from New York, everybody. And again, John, thank you. And Rob and Bob, it's great to see you guys and collaborate. So I'm just gonna take a couple of quick minutes here just to talk about some transaction activity that has occurred during the recent past. You know, immediately after the call it March 15th, when the pandemic became a real thing here in the United States, you all of a sudden had a rash of capital swoop in and invest in all sorts of leisure time industry platforms, whether it be hotels, cruise lines, Airbnb. You know, these headlines sort of, speak to it all. Two things I'd like to point out that I find very interesting. Blackstone and Starwood making big bets on extended stay America. And, the numbers actually have proven out that extended stay really is a durable model during times like this. The other very interesting that I find transaction is the Ritz in London, which the day that the transaction closed, literally the 100-year-old hotel shut down for operations. So I thought that was kind of interesting. Also very interesting that it went for big dollars. Airbnb obviously had 2 rounds of funding, and now they're talking about an IPO, which again I find that pretty interesting as well. So the $1 million question, immediately after March 15th, I was getting inundated with calls. How much is market value down? And my answer was I didn't know, and I was somewhat amused by many who pontificated that anywhere between 10 and 50%, 50. I don't know how they knew, because this is what I do day in and day out. It's a hobby for me. I love what I do, and again I had no idea. I think as time has gone on, we clearly have narrowed that down a little bit, and I'm sure Rob and Bob are going to weigh in on this as well. I think it is important to understand the difference between market value and liquidation value, right? There are various definitions of market value. This one's pretty straightforward. They all mean the same thing: willing buyer, willing seller, neither under duress, right? As opposed to liquidation value, which tends to be a distressed situation, and in most cases ends up being an all-cash transaction as opposed to taking advantage of debt leverage. So this table actually illustrates what John was alluding to just a little while ago. I mean, it's really remarkable when you compare Q2 2020 with Q2 2019. Major U.S. hotel sales, these are $10 million or more individual transactions. These are not allocations of portfolios to individual assets. These are pure individual trades. And so we can see that transaction volume is down, 83%, total dollar amount, 90%. It's just really remarkable. And then the average sale price per key down about 40%. So that fits in nicely to the nice broad range, 10 to 50% earlier. Some of the major sales that did occur in Q2, the Renaissance up in Baltimore, which I'm going to talk about in a minute, the Hutton in Nashville, Union Station in Nashville as well, a Courtyard down in Florida, a Quality Inn in Kissimmee, and a Shore Stay Suites, I believe, also in Florida. And then in Q3, there's already been announced a handful of transactions. The most prominent one, the L'Hermitage in Beverly Hills, which it's been announced that there's a buyer at $100 million. There was supposed to be an auction to see if they could clear a higher bid, and the auction ended up being canceled. So it is kind of interesting. This trade is, I think, at close to $900,000 a room. Apple REIT just picked up a dual-branded Hyatt property in Arizona. It actually was a forward sale that they just closed on upon opening. Another interesting one is the one in the lower left-hand corner, the Ramada Hialeah. Well-located property. Obviously, the asset physically and functionally obsolete. It was bought by a multifamily developer. Just drilling in a little bit on the Renaissance in Baltimore. This is, as far as I know, the only transaction so far that the world can point to get some sort of sense of value erosion. And the deal was originally supposed to go down pre-COVID at about 100 million. It ultimately went down at 80 million. So everybody's been sort of focused on that 20% whack. I think it's important to recognize that the deal also changed in that there was a requirement post-COVID to post 12 months of interest reserve as well as an operating shortfall reserve. So that 20% is really not 20%, but again, it is an indication. And then the last thing I just want to show is this is way back in 2001 when Blackstone bought Homestead Village Studio Suites. I actually remember working on this deal. The contract was signed in August. And the deal obviously created right after 9/11, and then it ultimately closed at $740 million. So we could see, that there's a what is that, a 15 to 20% decline in that transaction. Granted, it was a long time ago, but I think generally speaking, what I'm hearing now is that folks are sort of honing in on somewhere between 15 and 30% decline in value. The last thing I want to say is that does not apply to every single hotel in America. It's a range. There are very likely hotels that are worth a lot less today than they were pre-COVID, above 30%, and there could very well be some that are only 10% decline. So it really is asset and market specific. Thank you, John.
Rob?
Rob's on mute.
There we go. This is, yes. Okay. So I was just, thanks for sharing that, Daniel. It's pretty sobering in many ways. And since transactions really are based on confidence, I thought I'd share this with you. This is a confidence meter that I've been doing for 10 years. Many of you on this webinar have participated in this, and I appreciate your help there. But essentially, I asked the same 7 questions because none of us have much attention span. So 7 questions twice a year to the Investment Roundtable, which is a group of managers and brokers and investors and lenders, and it's really a great cross-section of our industry. It used to be associated with ULI, now it's with H and LA. And we take all of your answers and put it into an algorithm, and it comes up with a single number, which is the confidence meter. And this is the meter over those 10 years. Down at the bottom was the first time I did this, which was May 2011. And at the top is May of 2020. And you can see over the years, this confidence has been largely, mostly positive, and it has been trending downward more conservatively over those years as we've had to deal with, the European crisis back in the summer of 2011, lagging group demand, flattening growth, government shutdowns, stock market volatility, change in administration. There was a bump here when Trump's tax reform passed, but that was really just temporary. And as I said, this was taken in May, and it's the first time that the meter has actually gone negative, which is pretty shocking. But I shouldn't say it's not surprising given the situation we're in currently. What's an interesting thing here, one of the major things that we discovered is that there's a massive shift of answers from are you a net seller or a net buyer, from selling to buying. So 96% of the respondents want to be buying hotels. And this is that same question over the last 10 years. And you can see in the beginning of this, back in 11, 12, 13, there was mostly buyers in the market, people that really wanted to take advantage of what they saw as a growing industry. And then in the middle 2000s, it started to moderate, where you started to see much more of a balance of buyers and sellers as sellers started to take advantage of the higher prices. And then really back in last year, you started to see a shift towards mostly sellers and fewer buyers. And again, the reason being is that values had gotten so high, owners were really saying, okay, it's time for me to cash out. And now here we are in May of 2020, and it's been a complete shift to buyers versus sellers. There was a lot of other questions. I won't take the time to go through all of them, but it's just interesting that the vast majority of the people feel like we're in this for at least a negative kind of territory for the next year or longer. Now what I thought I'd share with you is something else that you might find interesting. It's a little bit of a historical perspective. So let me get this. So just give me a moment to describe this. These two charts show the impact following the last two downturns. So the left is the 9/11 attacks, and then the right is the great financial crisis. And this shows the decline in occupancy, ADR, and RevPAR from the triggering event for each downturn. And what you'll see here is that really RevPAR, which is the black line, took about 11 months to hit rock bottom on a trailing 12 basis to 17 months, so kind of a year to a year and a half from the triggering event. It took RevPAR to hit rock bottom. For full recovery back to, on a nominal basis, back to where it was at the triggering event, it took 4 to 5 years. What I find really interesting, so if you could just remember that, it takes 4 to 5 years to get back to where we started from the triggering event in RevPAR. Take a look at this. Focus on the blue line, which is the dollars per key of hotel transactions, so the value. And if you look at the 9/11, it took about 11 months to 21 months, really almost 2 years to hit rock bottom in terms of values. But then it took 6 months to get back up to where we were at the triggering event. For the great financial crisis, it took about 17 months to hit rock bottom, and that was about a 40% decline in dollars per room, 21% for the 9/11. But then it took 7 months to get values back up to where they were at the triggering event. So really, a real takeaway from this is it takes about a year to year and a half for values to really find their bottom before they turn the corner. And then once they turn the corner and money really starts piling in, the value recovery is very quick and about half as long as the RevPAR recovery takes. 24 months versus 55, 27 months versus 45 for 9/11. So once values start going up and growth starts, people feel more certain, more confident, they really are piling into the market very quickly, and values jump up very fast.
That's great, Rob. Bob, do you want to show yours?
Sure. And thanks, John, for inviting me here. And great stuff, Dan and Rob. I hadn't seen those stats, so that was really interesting. I appreciate that. I'm going to share a kind of a sample of where we think the bid-ask spread is today. And essentially, the trading of assets today does not really represent overall value in the market, because typically, and we experienced this coming out of the GFC, typically the first trades that get made are trades where the bid-ask spread is more narrow, and that occurs at what we would call the durable end of the market, durable assets in durable markets, and so the trading that occurs, it's usually on the lower end of the scale. We're actually marketing 2 assets right now, 2 durable assets in a top tier market, and we're finding pricing decline to be in the 10 to 15 range, closer to 10. So I think as these spot liquidity trades occur, in the coming months, I think we're going to continue to see a bid-ask spread that's on the more narrow level. If you can see from this graphic here, what's interesting is there's one variable that will impact both the ask and the bid, and that's the variable of time. Time reduces the amount of risk for the bidders, so theoretically they should be able to bid up as time goes on from where they were certainly months ago, and the ask will be under liquidity pressure with time. So theoretically, they may be willing to sell at a lower price than they were willing to sell before. And so kind of as we go forward, what will impact the level of trading, I think probably at the beginning of next year, are going to be a category of assets that we would define as forced liquidity trades. These are assets that, because of the pressure of time and the compounding effect of expense and carry and burn, that will create balance sheet pressure that will either capitulate the hotel into the debt senior constituents of the debt stack, or they'll have to be capitulated by the equity or other junior constituents. So those forced liquidity trades could gap out pricing for a period of time. But to Rob's point, there's so much capital waiting for opportunity, and I think it's at a magnitude, an order of magnitude greater than the GFC, and so I think pricing might surprise to the upside. I know in the assets that we've been selling that pricing has been better because competition's been better for those assets. 10 to 15 bids per asset. So we'll see where that goes. This is all very complicated, impossible to predict. None of us have ever lived through something like this.
That's interesting. If the big question obviously is, I think, timing. If you look at Rob's slide, it was 12 to 18 months before it hit bottom, which means that would be the middle of next March to the end of next year. So we still have, and that was a situation that's probably not as bad as the one we're in now, because everyone has predicted that this is a greater negative impact than the previous two downturns. So if that's the case, you're looking at 1 to 2 years of whatever we're in now to live through. And then what's odd is the amount of capital that's out there right now. We didn't have that before. I don't think we had that in 9/11. I don't think, maybe we did. I don't remember. We didn't have it in 2008. So timing wise, maybe this is for a Rob Klein question. Do you think that timing is going to be extended? And then why is there all this capital now that wasn't there the last time?
Well, there's based on, and there's different reports, and so don't quote me as exact on this, but the one that I saw, there's $200 billion of dry powder equity as of Q2, and you figure a leverage, leveraging that, you've got $500 to $700 billion of dry powder available to buy real estate. I think one of the reasons why it's become, why it's different than the last cycle is because the market has matured. The private equity market has matured dramatically over the last 10 years. As there's been a flight to find yield, pension funds and endowments, their stock market value of their investments has continued to climb, and they want to have a certain percentage of their overall portfolio invested in real estate, somewhere between 2 and 4%. And so as the value of their equities has increased, they found that they were underinvested in real estate. And a lot of these private equity firms that are managing their money rushed in to fill that need and started raising real estate funds. And they're smart, and so they knew there was going to be a downturn coming at some point, so they sat on that money. And now the opportunity appears to be presenting itself for investment. And so if you look at that $200 billion that's out there, 70% of it is allocated towards distressed, opportunistic, and value-add assets. So there's a huge amount of dry equity sitting there, assuming the financing markets will reemerge to lever those funds. There could be, if a majority of that is considering hotels because of the severe distress that's happened, you could, and I think total, and Daniel and Bob will correct me if I got this wrong, but I think total hotel transactions in 2019 were around $40 billion. That's single asset and portfolio. So you've got 600 to $700 billion of buying power in real estate, most of it focused on distressed, opportunistic value add. You could have, there's so much equity there, it would dwarf what has occurred in the past in terms of active trading year in the hotel space. So again, back to that point that you could see that once money starts coming into this sector, values could resurge pretty quickly. How long is it going to take for people to start buying, I think is an interesting question too. When are assets going to become available?
Well, isn't, maybe this is for Bob, isn't a lot of that capital rescue capital or, runway capital, whatever you want to call it, that maybe is buying down debt or, doing JVs or coming into stabilized deals that are, have merit for the long run rather than actual outright acquisitions? Isn't that easier for capital to get into the market that way?
Well, that's what's been happening. And it's been happening because nothing's on the market, right? And so if you have a durable asset, you're going to get good attention and very little discounting. Sell those assets if you want to secure some liquidity. But if you have a more vulnerable asset, the value loss there is significantly higher, and so most owners are choosing to hold and wait this out. And so that's why capital, to Rob's point, the capital will find a way into the system. And so far, they've found a way through rescue capital and some preferred equity investments that we've seen. So that's the way capitalism works. It finds a way to a need, right? And that's right now that need is not, the sale of deeply discounted hotels, but that probably will change.
Yeah. Well, it seems maybe I'm just not in the loop, but I have not heard or seen a lot of that yet. There's a lot of discussion of it, but a lot of owners are still in the forbearance period or coming to the end of it. And, the last downturn, pretend to extend, was the favorite term that allowed people to survive for 2 years, it seems like, without having to face the facts of foreclosure. And other than maybe CMBS, Daniel, your experience so far with CMBS versus, balance sheet lenders, have you seen more pressure on the CMBS side to dispose of assets versus, the traditional banks or insurance companies?
Can't say I necessarily have seen more pressure. I think the special servicers, I think everybody knows, this was such a sudden event. The special servicers were caught off guard, right? And they are just taking stuff in at an incredibly fast rate, and they don't know what to do first. So they're staffing up. Yes, there's pressure there. It's interesting. I'm aware of a certain transaction where, it went into special right around the end of March. The ask was for a 6-month forbearance, amongst a few other things. The special hasn't even responded to the ask, right? And guess what? The 6 months are already gone. So I also think that, everybody's sort of been playing nicely in the sandbox up until now. I do believe that come post Labor Day and as we go towards the end of the year, the sharp elbows are going to come out. I also would like to just address, you talked about the timing, and everybody does look at 9/11 and the great financial crisis, which is, somewhat appropriate. I think the disconnect is, and answering your earlier question, those were for the most part one and done deals, right? And so looking at Rob's, tables, right? The clock started when it was done, right? The problem here is that we don't know when it's done, right? Everybody thought it would be done by now. And that really is sort of the $1 trillion question. When will this be done? The last thing I want to point out is, I think Bob mentioned this, with all the capital that's out there, and let's face it, America is littered with functionally and physically obsolete hotels, that many of which were on the, at the edge of the cliff pre-COVID. Those type of assets are going to definitely experience severe decline in value pre-COVID versus post-COVID. But the desirable assets that have a real compelling value add story to them with all the capital that's out there, I truly believe that we will see distressed sales, but not necessarily distressed pricing.
Okay. You know, the industry has made somewhat of a recovery since early April. It was, I think, industry-wide occupancy was 16%. Now it's up around 40. You know, a lot of that was driven by leisure travel in the summer, you know, to the drive-to markets. But I'm not sure what happens now when kids are trying to go back to school, or at least doing virtual learning. You know, what happens now with the performance of the industry? And that was an average. So if maybe you're in Myrtle Beach, you have decent occupancy, or a beach in Florida, anything that has a resort in its name is great. But if you're in Oahu, you're running at 20% occupancy, or Manhattan, maybe a little bit better. But I know, Rob, what do you think about what happens this fall with the performance of the industry?
Well, I think, you know, two things to consider. One is I do watch the TSA throughput stats, and, you know, a typical day, TSA would have about 2.5 million people passing through their gates. And that's now down to about 600,000 to 800,000 a day, which is up from where the low point was, which was 90,000 people a day. So that seems to be increasing, but it's also kind of flattened and stabilized as people's travel expectations pulled back a little bit during this kind of resurgence of cases. The other thing that I could share is that we do manage and own a bunch of drive-to resort properties. And one thing that's kind of interesting that we're seeing is that because of virtual learning, families are able to travel not just on the weekends, but on the weekdays as well. They just take their kids with them and take their computers with them. Now that school is, you know, pretty, you know, across the country, mostly is at home learning again this semester. It'll be interesting to see in this fall whether people are traveling midweek with their families to get some away time. We certainly saw that in kind of May and June. July and August, a little harder to pinpoint because school wasn't happening, but there was a lot of travel midweek with families that we noticed at our properties. So hopefully that trend will continue into the fall.
Okay. Bob, what are your thoughts about the union markets like New York or San Francisco, Chicago? I would think they'd be the last to recover due to their cost structures and just the lack of people traveling to those markets for one reason or another. What are your thoughts on those markets?
The last to recover from an NOI standpoint?
Yeah,
or,
right.
Yeah.
There's a lot of group houses there too.
I probably wouldn't bet against New York City. I mean, it's one of the great cities in the world. Chicago's a great city as well. But there's no question that the stress has been imposed at a much greater level in these high cost markets. And certainly Chicago and New York are two good examples of that. I think what will happen in those markets is you'll see thousands of rooms taken out of inventory permanently. You're already seeing that in New York, and I think you're seeing examples of that in Chicago. But you know, and the demand recovery and when people start occupying offices and therefore people coming in to visit those people who are occupying offices, that time component variable is anyone's guess as to when demand comes back. So I think there will be some significant value degradation in certain asset types. Dan probably knows this because he does the research, but we're finding that the burn rate of a large full-service hotel in those markets is anywhere between $1,000 to $3,000 per key per month. So if you have a 1,000-room hotel, that's $1 million to $3 million a month. That's just to own a hotel that's essentially closed. So that creates stress and it compounds on itself. as I said earlier. So so those markets will suffer some losses for sure.
Yeah, in terms of the timing of when people are comfortable traveling, is complicated because you have the virus spreading at different rates in different areas, and people have gotten used to working virtually, and they are psychologically fearful for good reason. It's hard to judge somebody's level of fear versus, whatever you think reality is, because nobody really knows. And you don't want to find out the hard way that you were wrong about whatever bet you made on travel, whatever. So you have the large corporations that are limiting travel, and there's no sign of them changing that I can see. Every time I hear a new announcement, it's moved out to beginning of 21.
Well, another interesting thing is imagine you're a travel planner for a large global company. How do you know where your people are allowed to travel to and visit? Each state has a different set of rules as to who can visit their state and who cannot visit their state. If you've ever seen like a chart, it's like a crazy spaghetti bowl. There's just no consistency, which is, I guess, understandable. But the fact is, if you're trying to, influence travel for your company, you really don't know whether you have to research whether somebody can travel from San Francisco to Chicago, or to go from Chicago to New York, or Miami to New York. Most of these states have set up rules that if you're coming from this group of locations, you can't come to our state. You can't come to our city.
Yeah, we have that issue with doing projects in Hawaii where, it's a 2-week quarantine a lot of times to go in and out of Hawaii. Plus, we have issues going from island to island. So for one of our staff to fly from Oahu to Maui, you have to get a special approval from the government to allow you to actually take that flight. And it's not necessarily certain that you're going to get it, and it takes a while. So you may have a meeting that pops up, but you can't get your government approval to get an airline ticket to get there. So there's a lot of complications with all of this, but what it tells us is there's no clear answer to when the cloud's going to lift here. It's unclear. So as long as it's this unclear, it seems like this whole situation is going to perpetuate itself. And the longer it goes on, the worse it will be, because you have the hotel industry or leisure industry is down 25%, I think thereabouts, on employment. That affects people that have been on unemployment. That's all burning off from the government. That's affecting state and local governments. Now you're seeing affecting colleges and universities. So it's just dominoes down the line, which doesn't necessarily change when capital jumps in, possibly, right? Because they're going to make a bet that you're close to the bottom and you're going to jump in. I don't know, is that how the psychology would work, Rob? Or how would you make a decision to jump in and invest capital in a hotel right now?
Well, I think Bob and Daniel have a broader perspective than I do, but one thing that people are gravitating to, and you see it often to this point in a downturn, looking at basis. What is my basis? Is this cheap enough on a cost to replace basis? And we're bidding on assets and looking to acquire assets, and largely that metric is how good does it feel to own this asset at that price. Even if we have to weather something out for the next 2 years, we'll come out of the other side and feel like, wow, we really got a great asset at a pretty cheap price. One thing I wanted to add in response, John, that is a little bit of a sidewinder that could really change all of this talk about transaction activity and when do assets become available and when do people come back into the market. There is a lot of talk amongst people within the government to provide debt relief or some form of government-backed financing for property owners. And the latest kind of calculus I've heard around that is that they'll take 10% of what your current indebtedness is on an asset, and the government would provide a guaranteed loan to backstop 10% of that. Banks would come in and loan against that guarantee from the government and give you some cash to bridge through this time. If owners get some kind of relief like that, either through lender relief or some government intervention, that's certainly going to forestall that forced liquidity that, Bob, you were showing in your graph before.
Is that a serious discussion? I've not heard of that.
It's
Yeah,
called the
there's-
HOPE Act, right?
Yeah, exactly. And it's got bipartisan support. You'd think that logic would prevail, but in dealing with the government, they can't even get this latest round of help passed. But there's also talk of the Treasury and the Fed doing things unilaterally, which they've got the power to do, to provide some additional relief to special servicers in the CMBS market, because that's absolutely needed. The delinquency rate right now is higher than it was even during the depths of the great financial crisis. So CMBS market is obviously in big trouble, and special services, their hands are really tied. There's only so much that they're able to do the way their documents are crafted. So the Fed or the Treasury, they have to come in and provide some relief to those special servicers so that they can deal with the problems.
They didn't do that in 2008, did they?
No,
but they didn't. The difference there was there was no burn rate. For the most part, hotels still had positive NOI even in the depths of that downturn, from 08 to 09 after Lehman's collapse. It's very different owning a hotel that, you have to pay $1 million to, collection of people who, require it, companies that require it. So that's the big difference here. And that's why, I think to some degree, first of all, nobody has this in their playbook. So,
right.
We're all kind of figuring this out together. That's why we're doing this webinar. But special servicers have a playbook, and it's very specific to Rob's point. They can't waver from it. So what will be interesting to see is if they are either forced to vary from it by the government, or whether they make decisions that preserve the bondholders' shares. So that's all to be determined. I do think too, when you're talking about the situation, because we have very little visibility, it's an incredibly inefficient market that we're in. But if you stick to the fundamentals of supply and demand, when the demand will come back is impossible to tell, but the demand will come back. This will be over at some point. Nobody knows when. But I think, there's probably, when we're making predictions at, this end of the crisis, it's, probably a dumb thing to do. But when you're making predictions when things are this bad, you're always going to think that the recovery won't be as good as what actually occurs. And I think demand could certainly spike at a much greater rate than what any of us would predict if we were forced to predict right now.
One thing we always know for sure is we don't know, and every cycle is different. Hey, Rob, I've got my lawn guys here now. You didn't get yours. So, Daniel, there's some thought that it's positive that 80% of the hotels in New York will survive, but maybe 20% won't. That'll be better for the people to hang on. It's not great if you're one of those owners, but do you really think there'll be that many hotels that never reopen those markets?
Well, I think we're already starting to see a fair number of hotels that have already announced closure, permanent closure, if you will. That's the bad news. The good news is that take the Bryant Park Hotel in Manhattan, right? It's going to be converted to office space. So, the notion of changing highest and best use is not something new. I think generally speaking, New York could use a net decrease of available rooms. And, I do believe you're going to see it in a lot of the, the major urban areas. I do want to sort of piggyback on Bob's comment about don't bet against New York. And maybe that's because I'm born and bred in New York and grew up in the 60s and 70s and 80s and, clearly remember the bad days, which to some degree are coming back, which is a little bit of a scary notion. But if you look at some of the, these tech companies that we talked about that are allowing folks to work remotely, right? Look what Facebook and Amazon have done recently in New York. Amazon bought the Lord & Taylor building from WeWork, right? Who were never able to do anything with it given all their issues, right? And Facebook taking the Farley post office, right? These are significant lease transactions that have occurred in New York City by, smart, sophisticated capital that employs lots of people. So, again, I would concur with Bob. Don't bet against New York. Frankly, don't bet against, San Francisco, which is also really like just taking it on the chin. It's really tough out there. Crime, what have you. But, going back to what Rob said, really, it's all about your basis in a deal. And, your question about when are the transactions going to start? I think they're going to start when the capitulation has to happen, right? So the gun is at everybody's head, but the trigger hasn't been pulled yet. When the trigger's pulled, there's no shortage of folks out there like Rob who are sitting on lots of dry powder and, again, focused on compelling stories that at the right basis make a whole lot of sense. The last thing I want to say is I was struck by your comment, John, about, occupancies were down to 16 and now they're up to 40. It's kind of remarkable, relativity, right? That sounds terrific, right? But 40% occupancy in the grand scheme of things is still horrific. So just kind of an interesting note.
That's all relative. I have a question from the audience about the double whammy of COVID and unrest and crime in large cities like Chicago or New York. That doesn't help the traveling public get encouraged to go somewhere, or Portland for that matter. Bob, what do you think that does to valuations or sales? Does it make any difference in the long run?
Well, it's supply and demand, the number of assets that are on the market versus the capital to clear those assets. Uncertainty clearly is a dynamic that gets hedged into underwriting. And so when you have not only COVID affecting demand, but then you have potential, social unrest that could delay demand from coming to that city. Those are going to be situations where, you could, at least in the short term or midterm, see, deeper discounts to pre-COVID values. Mostly because the way the math would work is that discount rate would have to accommodate for that extra risk. And whether it's perceived or real risk, it still impacts value. It always does.
If you're concerned about crime and social unrest, I'd be very concerned about the day after Election Day and the days after that.
Yeah, regardless of who wins, I think that is a touch point.
That's going to be the issue. Nobody's going to know who won. It's going to be
Take a week probably. So Rob, what do you think about the brand situation right now? Because I think for once this may have stopped brand proliferation for a while because they don't have the ability to roll out new brands. And there could be opportunities within the brand pipeline for acquisitions or value adds because they have significant pipelines that are probably in trouble, whether it's Marriott or Hilton or Hyatt, all those projects, whether they are ground up or existing or the conversions, all those deals are not going ahead. And there are people probably just threw up their hands and said, I'm done, forget it. There may be opportunities within those pipelines that you might not normally think of looking to. What are your thoughts on the brand situation?
Yeah, I think there's a lot going on there that needs to be unpacked. But one thing that I think as a transactions conversation, we should start to think about is the brands have relaxed their standards. They're no longer doing standard checkups and forcing people to adhere to standards. They've allowed owners to utilize the FF&E reserves and divert those funds for purposes of paying operating expenses and your debt. And that's all was really smart and important to do. I think everybody thought that relief period was going to be relatively short, like 3, 4, or 5 months at most. Now we're looking at this really extending into next year. And so think about all these hotels that have not had money spent on them and have had the standards essentially removed. So if you're looking at buying hotels, you have to acknowledge and recognize that there was a lot of money that normally would have been spent just maintaining that asset that has not been spent. And you could be looking back a year or a year and a half and saying, wow, there's been not a penny of FF&E reserve spent on just normal maintenance type things on this asset. So I think that's something that will also affect values. And I think brands, you look at the brands, their stocks are down about 30%. They've done better than REITs, but they've got intense liquidity issues themselves. And they've had to do mass layoffs and massive furloughs. And you're seeing just this kind of brain drain from the brands happening. And that I think is going to affect support for hotel owners. So I think over time, you're going to see more and more owners question, what's the value of this brand on my building? Who is our customer going forward? It's changing. The brand's predicting who that customer is going to be, accessing those customers. I don't know. We'll see. But I think there's a lot of change happening there, and just a devastation of talented people.
Well, not only that, but people, they're not getting paid. I'm sure a lot of their licensing fees because there isn't the money for it. People are paying utilities or whatever they're paying for their hotel, and they're not necessarily paying every bill that they have because they don't have the liquidity. And
Right.
Liquidity is obviously everything right now.
Yeah.
What about the alternative lodging market, Rob? Do you think that gets stronger with a Sonder, or I think Lyric may have shut down. I'm not quite sure if I heard that right.
Lyric shut down, but you are seeing, and Daniel showed the slide at the beginning of Sonder raising $150 million, Airbnb raising $1 billion, and going, planning to go public. I think you are going to see that resurgence, and a big part of that is that people want to travel in bubbles. I want to travel with my family or with the group of friends that I have. And we can't go out to restaurants and bars and concerts and events. So we're really just self-entertaining. So we're just picking ourselves up in our bubble and moving ourselves to another location that may be a little bit more nature-centric. But what are we doing with our time? We're spending it together. We don't need a hotel for that. Let's rent a house where there's a kitchen and there's more space, there's a backyard, and maybe it's in a nature area. So I think that's what you're seeing. The other thing that I'm starting to see amongst younger people is that now that remote work is the norm, particularly amongst tech firms, and I may be a little bit biased because I'm in San Francisco and see more tech workers, but they're being allowed to work from home. So they're picking their home up and they're moving it around. They're gonna travel and work at the same time. They'll move to Park City for 3 or 4 months and rent an alternative accommodation. Then they'll go to New York. Then they'll go to they'll just move around the country while they're working, and so that will be a source of demand for alternative accommodation as well.
Yeah, Daniel, are there new legal issues with this? I know you wrote an article about the Steve Rushmore approach to valuation. Could you, without getting too in the weeds, do you think that difference of opinion and valuation between what the courts are saying and what you're saying is going to play a role in all this in terms of valuation?
I don't think so. And what you're referring to is a Florida case dealing with Disney Yacht and Beach Club, where essentially the taxing authority utilizes what's commonly termed as the Rushmore approach, and a court shot that down and had suggested that a more appropriate method for valuing that hotel would be not to use the actual income and expense, but rather assume that the food and beverage and the convention space is leased out to a third-party operator, if you will, and take that assumed rental amount as income to capitalize. there's a dramatic difference if you assume that the lease scenario versus owner-operated scenario. In any event, that's what that article was about, and that decision has been reversed. So that is a property tax issue. What I find interesting is that it really doesn't matter. What happens. Everybody appeals their tax assessment, right? I mean, everybody who owns a home does it, right? Everybody who owns a hotel, you automatically appeal your tax assessment, which is great on the one hand. On the other hand, everybody else is doing it, right? And so if everybody gets that sort of relief and reduced assessment, okay, that's the good news. The bad news is that every municipality in America is scrounging around for dollars and cents, and they have a budget to fill, right? And how are tax rates determined? Well, you take the total assessed value of the municipality against the budget, and you back into the tax rate. So although your assessment may come down dramatically, invariably the tax rate's going to go up, and hence property taxes, they go up. I've never, ever seen property taxes go down on a long-term basis.
Okay. Had a couple of questions from the audience. This is, I guess, a good one for Bob. What are the top 3 hurdles in the current bid-ask spread?
Financing would be one, and then the discount in value from pre-COVID. That's first of all, you have to agree on what pre-COVID value was, and that's a debate in its own right. And then you have to decide, based on the math of your projected return, how long you have to carry the property, and what are you willing to pay for that risk of carrying it. So that's those would be the components that would get in the way of a bid-ask spread narrowing to the point of agreement.
What do you think for underwriting you'd use for a carry period right now?
It depends solely on property type, market, location. A fly to destination resort, you would underwrite completely different than a drive to resort in a large metropolitan area. So it varies greatly, wildly. If you're talking about a convention hotel in New York City, you'd have to, probably put in, double what you would put in that other scenario.
Right.
Where CBRE's research group, which is a very deep, talented group within our company, they're projecting that we get back to RevPAR by the second quarter of 2024.
It's a ways off.
It's a ways off.
That's kind of in line with what Rob was saying earlier, though.
Yeah, it is. If you looked at Rob's sheets that, coming out of the GFC, it's not dissimilar. This is a situation much worse than the GFC.
Yeah. When do you project the bulk of the distressed upper upscale hotels come to market?
Next year. Next year. Yeah, it's too complicated. First of all, you have to determine, in the capital stack, who owns the asset first, and that's that's usually legal in nature, and so that takes a tremendous amount of time. I mean, just think of the court system. How I can't even envision how you settle the volume of decisions that need to take place before you can assume rights of ownership to be able to make the decision to sell in the first place.
Yeah, I think we heard last week that the courts are basically going to tell people, go back and work it out. They're not going to want to get involved, at least not right now.
Well, I think in the last downturn, I don't have the number exactly right, but I think there were only about 450 foreclosures that occurred following the great financial crisis. So, lenders and borrowers do tend to work things out. I think what's so unique about this particular situation is that somebody's got to be writing the checks to carry these properties. In the past downturns, hotels were still generating enough money to cover their expenses, their operating expenses. in this situation, as Bob said earlier, virtually most every hotel in the country is not covering their operating expenses, let alone their debt. So who's going to write that check? So I think it's really will bring lenders to the table to find solutions and look to the owner to motivate them to continue to write those checks.
But with the CMBS market, it's going to be a real challenge to deal with that, because they really need to stick to the letter of the law of all the REMIC rules.
Yeah, so how do they, I mean, we've dealt with clients where we've shut down hotels for them or with them, and it's not cheap to keep the hotel shut down. In some cases, we found it was more economical to be open and keep your systems operating. And for a while, in one big property, we had 6 people a week for several weeks. Now it's up to 50%. But if you're in a CMBS deal and you don't have the money to maintain the hotel, what happens? Do they just shut down and turn off the power and say, see you later? Daniel, what do you think about that?
I think the fat lady hasn't sung yet. It's going to be interesting to see, what does happen, because as you correctly said, it costs money to just own the asset, whether it's open or closed. I don't know.
It costs money to reopen an asset too.
That too, for sure.
I would think, Rob, in your experience, did you shut down most of your hotels, or did you leave them open?
It's about half and half. And the ones we left open were because there was some base contract business that supported us to keep them open. But they're operating at 10% and slightly above occupancy levels.
And have you reopened some that were closed?
No.
No. Okay, so you've held firm with your original strategy then.
There was a moment in time in late May, early June, where we started making plans to reopen. But then the case count, skyrocketed, and that dampened travel expectations. And so it really, now we're looking at saying, okay, well, we've lost the summer. The September, October doesn't look like it's going to get any better. So it doesn't make sense to open now just to find out that, we're in the winter months of November, December, January, February, where in a market like Chicago, there's very little travel anyway during those times.
Right.
Years. So doesn't make sense to open until, late March or early April of next year at best.
Rob, are you using your own coronavirus metrics, or in terms of deciding whether you look to reopen, or are you going strictly on what kind of business demand you're seeing? Or are they the same thing?
Definitely, Bob mentioned the cost to reopen a hotel. So, the fear is that you invest that money to reopen and travel doesn't really steadily increase. Cases increase and travel drops again. You've just wasted that money that it costs to reopen because you're probably going to close your hotel again. So
that happened with the property we're involved with in Miami Beach. It's a high-end property. We reopened it, and then they shut down the beaches and the bars again, and it shut down again, which was really painful.
Yeah.
Rob, I'm curious, is the majority of your debt balance sheet or CMBS?
The majority is a balance sheet, but we did refinance, I think it was February 19th, closed on a CMBS debt. So we may have been the last one to get a CMBS debt done. But that's one situation where we do have a CMBS loan. Yeah. Most of all the rest is bank debt.
And I'm sure you would agree that it's a lot easier sort of discussing workout solutions with balance sheet lenders than CMBS debt.
Yeah, absolutely. Definitely, there's somebody there to have a conversation with, and somebody that understands, that they have flexibility, and so they can the bank can assess their own level of risk and adjust to what level of risk they're willing to take.
So, John, going back to your question about who pays for this, right? I mean, obviously, somebody like Rob is not going to be reinvesting money into an asset if he doesn't know what the outlook for his structure, his capital structure is after doing that, right? And so with balance sheet lenders, you can do that. With CMBS lenders, it's really a tough proposition.
Yeah.
And what I find fascinating is when we do get to the backside of this, which will happen. It's not a matter of if, it's when. But what happens to the CMBS market? Does it come back in a new form, or is it sort of done at this point?
It never really came back completely.
Fair enough.
And I don't see how I don't know. I know people get attracted by the low rates, but there's so many problems with CMBS loans. I personally would never do one after the last two cycles. So Bob and Rob, what do you think? When do you see big convention hotels coming to market, like the New Orleans Hyatt or the Hilton downtown Atlanta or Marriott Marquis in New York? What happens with these behemoths that are totally group oriented? They're way behind even the rest of the market. Bob, what do you think?
Well, no idea. I really don't. I would suspect, again, because
I was sure you knew the answer to that.
Yeah, I just don't want to make a prediction because I'll be wrong. But I think because of the high fixed costs of these large hotels with no demand to support those costs, and the magnitude of that burn rate that I was talking about earlier, at some point, depending on the capital structure, no one wants to own it. And so, those kinds of assets will probably capitulate quicker. Other assets are great assets, except, in a 100-year flood, and owners will probably try to protect those assets. And if they have the capital to do it, they will. Because you wouldn't, theoretically, you wouldn't want to sell into this kind of uncertainty at this end of the market, the large convention hotel end of the market. There are certain situations where these large hotels were refinanced just last year. And so what happens to those loans, where clearly, the equity was recapitalized and now you have this burn that, people don't want to pay. Investors don't want to pay.
I think you're also going to see a lot of large hotels that are just old assets. The Roosevelt in New York. Yeah. The Hotel Pennsylvania in New York. Right. It'll be very interesting to see whether those assets actually reopen as hotels. Yeah. By the way, they're both tremendous development sites. I mean, they're well located. And if you look back over the past 10, 15, 20 years at those particular assets, they were contemplated previously for being redeveloped into office, residential, maybe a small hotel component. I think now, you're going to finally see some of that happen with large hotels like that, let's face it, they're functionally obsolete.
Yeah. We spent a huge amount of time consulting on one of those two hotels for the owner. It's very well known, I won't mention. And it was a big number to redevelop it as a hotel, but there wasn't the demand for a 1 million square foot office building. So they're kind of stuck in between what they have, which is not good, but what they want, which doesn't exist. So I don't see I don't know what happens with those kind of deals. They're just going to limp along at best, because they were profitable, even though they were horrible properties. Whether those still survive, I have no idea. We had another question about, will there be an RTC type liquidator? It would seem that in this kind of situation, which is probably only going to get worse as near as we can tell, there's nothing on the horizon right now that says you can clearly point to that says this is where it's going to start to get better. There may be a vaccine after the first of the year, but you've got people that don't want to take it. There's going to be questions about its effectiveness. Even if it's good, it's going to take probably half the year or more to even get enough people to take it that it has any positive effect. In the meantime, you have more carnage on the economic side. So it seems like this would be a time when you would need an RTC type liquidator, especially for CMBS deals. And I don't know what percentage of the market is CMBS, but how do you, if the market is somewhat frozen in terms of transactions, how do you clear all this in order to get everything functioning again?
Well, before we answer that, let's not forget how the RTC came about, right? It came about that the government was essentially the RTC because you had all these savings and loans that went belly up, right? And so the government seized all those assets and then had to do something with them, right? At the
1,600 of them went out.
At the inception of the RTC, the United States government was the largest hotel owner in America. So, what's gonna translate into some governmental entity like the RTC to represent that clearinghouse? I'm not really sure whether that happens at all.
Well, it would probably be someone like the Fed, right? Because they're investing in all kinds of things now that you never would have thought they would have invested in. And they're the ones that seem to be the more aggressive in terms of their market support.
Yeah, they're investing heavily in bonds, and so yeah, that could, but it could be that the problems, we live in our bubbles of hotel real estate and within the commercial real estate world, but there's problems throughout the entire economy. It's not just isolated to commercial property. So the problems that are out there are much larger than our little tiny speck of the world. I think what's going to motivate, hopefully will motivate local governments, is that they depend on the sales and occupancy tax revenues that are coming from these hotels. And to have these hotels closed in their cities, not generating tax revenue, they can't get money to operate their cities and their communities. So, there's the pendulum will swing. What's going to trigger that will either be, the near bankruptcy in cities, or some development of therapeutics or vaccines. And otherwise, local politicians are highly motivated to get these hotels and restaurants reopened and generating tax base for them.
It's interesting bringing up the Fed and investment, right? Look at New York City. The Metropolitan Transit Authority in New York is on the verge of blowing up, and is in dire need of money, right? So where does the money go first? Does it go to saving mass transit, right, which is obviously very important, right? Or does it go to saving hotel assets, right? What about the airlines? I mean, there's so many other industries that are in need of support from the government that I guess, sure, we can just keep printing money and doling it out, but there are consequences associated with that.
Right. You mentioned the state and local taxes. In our jurisdiction, where we have a development project in Atlanta, the city of Sandy Springs, which is one of the jurisdictions, they would normally get $400,000 to $500,000 a month from the central perimeter hotel market. They're getting $10,000 a month now. And Bob, the concourse development well.
Yeah.
They would normally have this is a big mixed use development, several million square feet of office, Class A office space, everything. They would normally have an occupancy of 3,000 people a day. They have 60. So it's pretty significant of what the impact has been. One last question that somebody asked about, the technical aspects. Are people doing any type of defensive strategies in building systems, whether it's HVAC or cleaning, disinfecting for rooms and clinics, spas, things like that? There was a lot of discussion about that when this first happened, doing UV systems and all these type of things. That has kind of gone away. In fact, we don't have, and people talk to us about what can we do at our hotel. That's gone away completely. Nobody's even talking about that, because a lot of it, these UV machines, first of all, they're dangerous if you don't know how to operate them. It's not that easy to go back and retrofit buildings. Plus, people don't have the liquidity to do it anyway. So I think a lot of these things that people talk about are not going to happen, at least not anytime soon, and people will work around it somehow. And people are staying in hotels now, and none of these hotels have done it for the most part. So I think it's somewhat of a moot point.
Well, the big thing is in office buildings, having to retrofit air conditioning. As the planes have retrofitted their air supply system, office buildings have to invest that money if they have any hope of attracting companies back to those spaces.
Yeah, we're even going to look at it for our office building, but that's a small 10,000 square feet. It's not a huge expense. Whether it ends up making sense or not, I don't know. But it's all the things you have to think about in dealing with this now. So anyway, any other thoughts you gentlemen have on the future and how you're looking at it? We just Bob, Rob, and kind of go around the horn. What are your thoughts about all this now, looking forward? Bob?
Just got to grind it out. We have to be nimble. We have to make sure that we're planning for as many scenarios as we can think of. And we have to continue to work real hard to help our clients through, this disaster for our industry. And that's first and foremost, I think, as far as what we're doing.
What do you think, Rob?
Yeah, I think, it's important to think about, the arc of trends and yes, this is a major downturn and a major blip, but have to stay confident that people will revert to the mean, which is we're social creatures. We like face-to-face interaction, whether it's for pleasure or for work or for conferencing. It's just a lot more effective to sit across the table from somebody or to share a meal with somebody. So I think we will get back to the trend lines that we were at before, but certainly this is an accelerant for anything that was weak to begin, as I think Daniel pointed out earlier. That has just sped up the destruction of those particular weakened trends or weakened properties. But we'll get back. We're going to get through this. Key is just to survive and keep fighting. I keep telling my team that one day turns into a week, and 1 week turns into a month, and months turn into years. We just have to keep moving forward and remember that people like to travel. We'll get back to that.
Yeah, remember the phrase survived to 95? We need a new phrase for this one.
Okay, Boomer.
Don't be on the floor in 24.
Yeah, that's a good one.
Daniel, don't be on the floor in 24. I like that, Rob.
That may be it. Daniel, what do you think?
Maintain hope and pray.
Yeah. Well, I tell you what we're doing is we're trying to just, figure it out as much as we can and maintain the communications. And actually these webinars that we've been doing have been very helpful for me, and I think for other people in our audience, because you guys are super experienced and very smart and very experienced. I think it helps everybody. I know it helps me just to hear your thoughts and your opinions and share the knowledge that you have, so we know a little bit more than we did before about where we're going and how we're going to get there. Sometimes what you don't know for sure helps you determine something, some action you take. So really appreciate your time. A lot of expertise here, and I hope this helped everybody. I know it helped me. But thanks for your time, guys.
Thank you.
Thank you.
Thank you.
Bye-bye.
Have a great day.
Bye. You too.